my name for those of you that are not my subscribers and may not know me. My name is Roulston. Been in the mining industry for a very long time. Background includes many years in management of mid-size and junior companies, and a few years as an analyst with one of the major mining companies. Been doing Resource Opportunities newsletter now for the last 13 years. And I'm also involved in an investment fund that focuses on exactly the same kind of companies that we follow in the newsletter and that we all know and love so well. So with that, my intent in this talk is to, first of all, talk very briefly about a kind of a big picture overview of the market. And then what I know you all want to hear about is where we are in this market cycle, what's coming next in the market. But before we get into looking forward, I think it's important to understand the bigger picture and where we've come from and look at it from a global perspective in order to understand what's around us. You know, putting this in a perspective, everything in the media these days is about what's happening today and yesterday, and it's all that short-term perspective. So many people lose track of the bigger picture. There was one little clip I heard on Bloomberg the other day where somebody was talking about a 4-hour chart. You know, and not only is he not seeing the forest, he's not even seeing the trees. He's looking at the moss growing on the trees and trying to figure out what's coming next. Now, if you're a day trader, you know, that kind of makes sense. But any other investor, you need to have some idea of what's going on in the bigger picture. Start off here, you know, we don't need to talk anymore about how bad the market has been over the last year. We're all fully aware of it. We're all licking our wounds and looking forward to what's coming next. The market has turned around. We've started to see the upturns in the market in the near term. But I really want to show this chart going back a little bit longer because many of us by now have forgotten what happened in 2008, 2009. It was a horrible, painful experience. But if you stuck in there at the end of 2009, or the beginning of, end of 2008, beginning of 2009, and just rode the market to the beginning of 2011, the venture index tripled in that time period. And where we are now, I believe we're in the same kind of situation as we were after the global financial crisis. We're in a situation where stocks are so badly beaten up. We're looking at valuations that are totally irrational on the downside, and we're starting to see moves to the upside. Just some of the indicators of where we are and what's starting to happen. And I realize you're not going to be able to read this chart. It's in that handout USB drive, but just as one indicator here. The upward sloping red line is the gold price. The downward sloping black line is the ratio of net asset value of gold producing companies to their price. For many, many years, gold producers traded at a premium to their net asset value. Beginning after the global financial crisis, that changed completely. And over the last few months, the gold producers have been trading at a discount to the net asset value. So it was, in my opinion, anyway, irrational for gold producers to be trading at a premium to net asset value. And therefore, I never covered the senior producers in the newsletter because I didn't think it made sense to pay a premium price to buy those companies. But now it's equally irrational on the downside. They're trading at a discount to their ability to generate positive cash flow. But you can see after hitting a low of 75% of net asset or price to net asset value that we're now back to 90%, but still a discount to the ability of these companies to generate cash flow. Again, just for a moment, staying with this theme of looking at the big picture. Over the last few months, gold price has been trending down, or over the last year. And so the media has been talking negatively about the gold prices as it's been moving down. Remember when gold was $1,900 an ounce? The media was all over it. Gold is the greatest thing. Everybody should own gold. At $1,600, nobody wanted to talk about it. And if you step back and look at the 10-year price chart, you'll realize that when gold was at $1,900, it's a great time to be selling it, not doing like the media is saying and getting excited about it. And at $1,600, it was a great time to be coming back into the market. It's starting to move up. I don't know where it's going. And I'm not going to try to play this game of guessing where the gold price is going to be on a specific date or time. But I think if you draw a band around that long-term trend and project that out, that's probably the best way to figure out where the gold price is going over the next months, years. And a really important point here, if you look at that trend line, you'll see that beginning of 2009, it started to slope up more steeply than it had in the past. And that's really significant. After the global financial crisis at the end of 2008, people started to realize that gold and other hard assets had a very, very important value component in a portfolio because it provides long-term stability. It's a long-term store of wealth. It's a hedge against currency debasement and depreciation, inflation. And so gold, after the global financial crisis, has become even more popular than it was before, and I think we're going to see that trend continue. Silver price, way more volatile than gold, but it's also up sixfold in a decade. And again, you get people looking at the last few months or the last year where it's been on a bit of a downtrend, losing track of the fact that it's on a huge long-term uptrend. And again, take a band around that trend, and that's the way to look at the silver price, trending higher but volatile. Copper price. Not everybody's aware that copper price is also currently at 6 times the level that it was at in 2001. That's exactly the same ratio as gold and silver. There's a mindset out there that says if the global economy is not doing very well, why in the world would you want to own anything to do with base metals? Well, let's have a quick look here. You know, Europe's in a recession, so let's say they're going to use 0.3% less metal this year than they used last year. They're not going from 100% to zero. They're going to use 99.7% as much metal this year as they used last year. The US is growing slightly, so they'll use a little more metal. China, which is by far the biggest consumer of metals, is growing at around 7%. Headlines are screaming out, China is slowing. No, it's not slowing. It's growing at 7% instead of 9 or 10%. It's still growing. It's using more metal every year. Added up, demand for metals is continuing to increase. And that's happening in the context of getting harder and harder and harder to increase supply of metals, and that's why the copper price is 6 times where it was a decade ago. Now, economists and a lot of mining analysts even will tell you that we're going to have mean reversion. You've heard this expression many times, I'm sure. It means that, you know, there's a mean, an average, and for a while something can be above the mean, and then it's going to go below the mean, and then it's going to come back to the mean. Well, they will tell you the reason that you have the mean reversion is because if a metal price is high, there'll be more production come on, more supply, and then it comes back into equilibrium. Let's look at the gold market over the last decade. Gold price is up 6-fold. Gold production has barely changed in a decade. And it's not because the likes of Barrick and Newmont don't want to increase production. They would desperately want to increase production. They're just not able to. There are serious constraints on the ability of the mining industry to increase supply. And that's why production is constrained and metal prices are high. And that is going to continue. Very briefly about why there are these constraints on ability to increase supply. Number one, look at the line in this chart shows spending on gold exploration over the last decade. And you can see that from $1 billion a year, actually 2 decades ago, $1 billion a year spending on gold exploration. It's now $5 billion a year spent looking for new gold deposits. And yet, the last time the gold mining industry found as much gold as it produced was in 1998. Gold production has exceeded new discoveries every year since 1998, in spite of massive spending on looking for new deposits. And another quick point to consider, average grade of a gold mine has fallen sharply. I doubt very many investors, And I know that many, many mining analysts don't understand that the average grade of a gold mine around the world right now is 1.3 grams per ton. And yet you still get mining analysts say, oh, if it doesn't have 2 or 3 or 4 grams, it's not worth it, it's not economic, it'll never work, 1 gram a ton deposit has no value, blah, blah, blah. One situation I'm looking at, they're making enormous profits on a deposit that's being mined at 0.3 grams per ton. Things are changing. It's a different industry. It's a different mindset required to look at the companies now, and that's really significant. Just to double check the figures in this chart, I looked at a list of all the gold reserves of all the mining companies and added up the grade, and the average grade of reserves of all the of the gold companies right now is 1.3 grams per ton. The resources is 0.8 grams per ton. So we're trending lower. Copper grade is also falling. And the significance of this is that deposits that had no value a couple of years ago, if we go back to this thing, imagine finding a deposit in the 70s or 80s when the average grade of a gold deposit was 6 grams a ton, and you find a deposit that only has a grade of 2 grams a ton. It has no value. It was thrown aside. And in the newsletter over the last few years, we've had tremendous success with companies that have gone back, picked up these deposits, and evaluate them in the current context of this market. Another very, very important aspect to what's happening in the market right now is that as much as investors may not put a lot of value on these junior companies, the larger mining companies are putting enormous value on the junior companies. And the reason we're talking about this overview and the grades and everything else in the context of the junior resource sector is because it's the small companies that are making the discoveries, that hold the development stage deposits, are going to be taken over by the larger companies to provide the basis for ongoing expansion. And bear in mind, an average mine has a life of about 20 years. And that means that just to stay flat in metal production, the mining industry has to replace half the production capacity every decade just to stay flat. And then, of course, growth in demand means we need even more. So the juniors are critically important to the mining industry. They're not getting much respect right now from investors, but believe it, the major mining companies are paying very close attention to these companies. Last year there was $149 billion of merger and acquisition activity in the mining industry, a significant portion of it being larger companies buying smaller companies. And in addition to that enormous size of that takeover activity, a really important statistic is that the average price paid in those acquisitions for the gold and the copper companies, the average price was a 46% premium to what investors were paying for those companies before the bid was made. So the majors are paying 46% more than the market price, and they're still thinking they're getting bargains because they're going through with the deals. There's going to be a lot more of that kind of takeover activity. We know that investor interest is returning to the industry right now. What are investors focused on? And the area that attracts the most interest, or at least the most dramatic level of interest, are companies that make new discoveries. And we saw that with GoldQuest. GoldQuest went along for the better part of a year at a few cents a share. They announced a couple of drill holes on a project in a trend that they'd been exploring for years, and the share price ended up over $2 a share. So it went from a nickel to $2 a share on the basis of a few drill holes. Again, hard to see that, but you can see the long-term, months and months dribbling along at a few pennies a share. They announced a couple of good drill holes and up as high as $2 a share. So investors clearly are paying attention to discoveries. But it's not just discoveries that are getting attention. The area that I focused on largely in the newsletter are companies that have deposits in hand and they're advancing them toward production. And here's one example of that, Santa Cruz. No particular hard news, just progress toward production and a doubling of the share price within a couple of months. And another example of huge gain in a share price, more than a double on this one, Intercitic. Intercitic received a takeover offer, and I think the first blip was rumors of the takeover offer, and then the second jump was the offer coming through. I mentioned that last year the average premium paid in takeovers of gold and copper companies was 46%. This offer came at more than 100% premium to market, and it's a cash offer. So there's certainly a lot of interest out there. Now, as much as we know that, things are starting to look up, the question hanging over a lot of people right now still is it going to continue? Are we going to have some black swan? Are we going to go back into all this negativity that we've dealt with over the last year? A few comments to suggest that the situation globally is improving and will probably support it. Now, I think I've demonstrated that the fundamentals in the mining industry are extremely positive. The global situation is still a big unknown. The European situation seems to be contained. This morning it was announced that the German courts have agreed to allow Germany to get more aggressive in terms of supporting the European Stabilization Fund. Another positive move. U.S. growth slow, but it's still positive, and there's potential for stimulus that could see that pick up. China last week made a big announcement on stimulus. They'd announced a number of smaller moves, but last week they kind of tied it together. $1 trillion, about $150 billion worth of stimulus, all aimed at infrastructure. Now, the U.S. and Europe, they're supporting the big banks, they're supporting, the sovereign bonds. China takes a totally different approach. They go out and they hire people to build ports and roads and rails and all the other stuff that in the future is going to make the country even more productive. So they're getting near-term jobs, stimulus, spending, money circulating, but at the end of the day, they'll have something tangible to show for it, not just a bank that should have failed that still exists, but they're creating hard assets. Earlier this year, we saw massive redemptions in hedge funds that held positions in these junior companies. And the hedge funds were forced to liquidate because of redemptions. The selling from the hedge funds created a downward spiral in the share prices, leading to irrational low values for these companies. The valuations at the start of the year were a lot higher than they are now. The valuations now are so irrationally low, it's hard to imagine some of these companies getting any cheaper. Gold producers are starting to return to net asset value. The gold price is strengthening. Base metal companies are still really out of favor, presenting tremendous opportunities. And regardless of investor sentiment, the major mining companies are buying. And we saw a week or two ago the bid for Intercitic was another example of the fact that these companies are buying. And so, add up all the pieces, the fundamentals are there, the near-term outlook looks very positive. This, looks like a very good time to be getting back into the market. So these companies that we're hearing about today are really worth paying attention to. I'll be around for part of the day. Glad to talk to anybody one-on-one. And at the end of the day, there'll be a panel where we can do some interaction and Q&A. Thank you very much.